Karima Munse has been in business for 22 years. She started with the pepper shrimp and she has come a very long way since then.
Our products are enjoyed by the entire family, from the on-the-go busy individual to the children who love our pepper shrimp, juice mixes, and beverages. We create products that makes the cooking experience more efficient and flavorful.
Customers wanted more products from Home Choice. So we decided to manufacture different types of products to meet the customer's needs. Home Choice is a family company, and looking at bringing on a partner is always a big decision to make.
When we initially met the team, there are a number of positives. First of all, we saw values fit.
Geopolitical conflicts, the uncertainty associated with operating in a post-COVID era, high inflation essentially everywhere, volatility in energy prices. According to a McKinsey study in September, these are the main issues facing us today. As part of the global economy, it is critical that we take the time to reflect on how these realities affect the conditions in our small island home, as well as our individual opportunities for wealth creation. Good evening, and welcome to Wealth Talks, your VM Wealth financial education series that helps you build on opportunities to create and grow your wealth. Today, we look at navigating market conditions to help you understand the current global and local markets and to learn strategies to optimize your portfolio. We have with us some highly experienced professionals today. Joining me on the stage is our Deputy CEO, Brian Fraser. Online joining us is Dr. Lindsay Payeksa. And joining us shortly will be Dr. Andre Horton. As well as in studio, we have with us Mr. Michael Neto as one of our panelists. I am your host for the evening, Nicole Adamson, and I am VM Wealth Management's Research and Investor Relations Manager. We are live on Facebook, YouTube, and Twitter, and I invite you to participate wherever you are by sharing your questions in the chat for our speakers and for your VM Wealth team. Thank you again for joining us. Our first speaker this afternoon is Dr. Lindsay Payeksa. She is the Chief Economist and Managing Director for Stifel Financial, a global wealth management and investment banking firm. She specializes in the research and analysis of economic trends and activity, world economies, financial markets, and monetary and fiscal policies. She is a thought leader and a regular contributor on CNN, CNBC, Bloomberg, and other leading media outlets. Dr. Payeksa is a respected author, and she's published numerous academic papers. We're privileged to have her as our first speaker today, and she joins us via Zoom. She'll be providing an overview of global market trends and the merits to local investors of including global assets in their portfolios. Welcome, Dr. Payeksa.
Thank you so much, and thank you for having me and giving me this opportunity to really comment on what we're seeing going on in the economy, particularly the U.S. economy, as we try to navigate this very difficult environment with so much uncertainty, so much unease. But I think looking at the U.S. and having a better understanding of what's happening in the U.S. economy really allows us a better baseline, a more informative baseline to continue to make the best investment decisions that we can, if it's in our domestic region in the U.S. or if it's simply understanding better the global picture during this recovery phase. But I want to focus on the U.S. economy, as I mentioned, and I do want to start from a 10,000-foot view. As we look at the latest release of domestic growth in the U.S., potentially suggesting a pickup in activity. The first look at Q3 GDP showed U.S. activity climbed over 2.5%, a welcomed improvement from 6 consecutive months of negative activity at the start of the year and the fastest growth rate that we've seen in the U.S. since the fourth quarter of last year. But we do have to be careful about being overly optimistic about improvements in the U.S. or globally. When we look at the US consumer specifically, what we see is that while growth remains positive, it did slow to a 1.4% pace. Meanwhile, gross private investment, this is a gauge of business spending, continued to trend negative, although slightly less negative than what we saw in the second quarter. Residential investment is also becoming a sizable drag, not just in the US, but globally, as consumers come under pressure, unable to buy those big ticket purchases. And in the US, we saw this contract by over 26%, following a near 18% drop the quarter prior. And finally, on the trade side, net exports were really the driver of growth in the US last quarter, but the gain was reflective of a 7% decline in imports, a sign of slower domestic demand. So certainly keeping in focus those deteriorating trade lines and the inability for consumers to continue to post large demand for overseas produced items. So again, while a welcome reprieve after 6 consecutive months of negative activity at the start of the year, that bump in third quarter growth, as we saw in the US, is likely to be a temporary boost rather than an indication of sustainable upward momentum. Remember, we were seeing lower gas prices. We had a bunch of renewed state and local stimulus in the US, with more than a dozen states or major cities implementing new rounds of direct payments. Not to mention, in the US, we are seeing an increased willingness to eat through the remaining savings. And something that consumers globally are experiencing, elevated inflation, is forcing us to spend money faster. And so what we see is that while spending remained positive July through September, it was at a minimal pace. And this has been enough to undermine that growth profile. Even with the third quarter increase, we see growth for the entire economy virtually flat when we average that out. Of course, from the central bank perspective, the Fed's perspective, this slump that we're seeing in residential investment or housing, and the increasingly apparent destruction in demand is a welcome indication that higher interest rate policy is having the intended impact on slowing the economy, something other central banks around the world are also trying to achieve. But that being said, with still positive momentum in spending, a 5-decade low in unemployment, and a near 4-decade high in prices, there is still more work to be done. More room for further rate increases, be that both in the US and throughout much of the developed world. In fact, I think while we can argue recessionary conditions are increasingly emerging in nearly every sector of the economy, the US economy, the labor market back in the US remains a bright spot, allowing the Federal Reserve to maintain its focus on controlling inflation. Now, other central banks globally are having more of a difficult time as emerging weakness is becoming increasingly prominent. But here in the US, fighting inflation, the labor market is still holding steady, allowing the Fed to redirect its focus entirely to the second half of its dual mandate, stable prices. After all, in the US, non-farm payrolls continue to rise at an average pace of about 420,000, as they have since the start of the year. And we're seeing widespread gains in the US across nearly every sector of the economy, from goods producing, manufacturing, construction, to the service sector, leisure and hospitality, health and education. And while we are awaiting in the US the key employment report tomorrow, and payrolls are expected to slow below a 200,000 pace, again, US businesses are still putting Americans back to work. Businesses are still willing to hire. We also see the unemployment rate in the US continuing its solid retreat from a double-digit pace back in the aftermath of the COVID recession. But here we have to be careful, because here we're seeing somewhat of an anomaly in terms of the US labor market. While many developed countries experienced a precipitous decline in unemployment, in the US, this is a reflection of two different themes. We are putting Americans back into a position of gainful employment, but we're also seeing that decline in the unemployment rate because millions of Americans are still remaining on the sideline, not actively participating in the labor market. And the way we calculate unemployment in the US, you have to be actively seeking a job to be counted as unemployed. So it's very easy to get the unemployment rate down to zero if nobody's looking for work, but that's certainly not indicative of a solid labor market. Now, of course, going forward, as these workers slowly return, we would expect then the opposite to occur, upward pressure on the unemployment rate. But it will take time. And in the meantime, as labor demand continues to outpace labor supply, we see prices elevated for that scarce resource, prices elevated for labor. And we continue to see wages at an extremely elevated pace, around 5% on an annual basis. Although, to be fair, looking all the way to the right-hand side of the chart, you can see some of that upward momentum has started to wane, and wages have begun to plateau. But again, while enough to maintain positive consumer activity, nominal wage gains at 5% have not been enough to maintain robust consumer activity, as consumers are already cutting back below that 2% pace. As fiscal stimulus wanes, as savings deplete, higher prices, as I mentioned, are eating into consumers' ability to buy goods and services out in the marketplace. So all of a sudden, when we talk about 5% wage gains in the US, well, against the backdrop of 6, 7, 8% inflation, depending on your favorite inflation metric, that leaves real wages trending negative for the better part of the past year, pulling the real pace of spending closer and closer to, well, certainly low single digits, but closer and closer to a zero level. So with that as a backdrop, central banks around the world have reaffirmed their commitment to reinstating price stability. Here in the US, the chairman has told us time and time again that price stability is the bedrock of the economy. And of course, this week we saw both the BOE and the Federal Reserve opting to raise rates 75 basis points. Yesterday, it was the fourth consecutive time the Federal Reserve has increased interest rates at that supersized pace, taking us now up to a 4% bound on the federal funds range. Now, of course, ahead of the November rate decision yesterday, the market was fully pricing in the latest hike. That was already baked into expectations. But going forward, now that's a bit less certain. Now, as such, the market was looking very closely at the language in the November statement and was hanging on the chairman's every word to try to discern any sort of indication as to the potential pathway for rates or indications of a potential reduction in the future rate in future rate increases. With 50 basis points now the majority consensus at just under 60%. One of the key phrases that investors were looking for, ongoing rate increases would be appropriate. Now, the Fed did maintain this guidance, but they also softened that language by including new language that mentioned lags of monetary policy. We know that when the Fed raises rates, there's not an immediate impact on the economy. And by the Fed specifically noting that lag between monetary policy decisions and the realized impact on the economy, well, this suggests that the Fed may be willing to reduce the size of rate hikes sooner than later in order to assess the impact of earlier hikes. At the same time, however, it was a bit of a bait and switch, if you will. The Fed went on to first reaffirm the solid pace of activity in the US. The chairman also went on to talk about that lag in monetary policy, saying that, yes, it's important to acknowledge it, but this time around, it's likely shorter in nature, given the anticipatory reaction of financial market conditions to monetary policy adjustments. And Powell also suggested that the terminal rate for Fed funds will be well above earlier forecasts. So again, as we talked about, the US economy, and by extension, the global economy, is losing steam, particularly in the areas of housing, consumers struggling to stay afloat as rising prices reduce purchasing power in the marketplace, the labor market, at least in the US, has remained solid throughout. And so for the Fed specifically, against the backdrop of a stronger than expected rise in third quarter growth, with inflation in the US and around the world continually surprising to the upside, the committee here in the US, the Federal Reserve, does appear to be on relatively firm ground to remain committed in its resolve to raise rates enough to quell inflation. In fact, yesterday the chairman noted that the risk for the Fed, and in fact the risk for central banks around the world, is not that monetary policy officials do too much or perhaps over tighten. No, he said the risk is that the Federal Reserve or central banks do too little and allow inflation to become entrenched within the respective domestic economies. And so with that, the Fed is expected to continue along this robust pace of rate increases, and arguably equally as important or even more important, the Fed is expected to revise higher its expectations for inflation and rates in the final summary of economic projections, which will be released at the end of the year. As of late, looking at that orange line, the latest summary of economic projections released in September suggests the Fed is anticipating a 4.4% Fed funds rate by the end of the year, reaching 4.6% sometime next year. The committee has, however, as you can see that ladder up from purple to green to orange, consistently revised higher their expectations for rates by nearly 200 basis points since that initial March forecast. And again, with inflation stubbornly elevated, well above central banks' targets across the globe, but specifically what the Fed was expecting by the end of the year, and even further above that 2% target range. We do expect the Fed will revise higher expectations, again, as I mentioned, for both rates and inflation, a fourth time in that final release of the CEP come December. So what does this mean for the market in terms of rates? Well, as the Fed continues to tighten, the short end will presumably move along with the Fed. The longer end of the curve, however, as I have proxied here by the 10-year US Treasury yield, the long end will struggle to keep up with the Fed as monetary policy, both in the US and globally, intentionally tightens. It tightens the economy into or further into recession. Remember, even with the market increase that we've seen in the US 10-year thus far, it has not been enough to overtake the 2-year Treasury yield. So what we're seeing is an inversion in the curve, an inversion that we do expect to continue throughout the year, up and down the term structure and well into 2023. Now, some are suggesting that a Fed pivot may come sooner than later, may come in the form of slower rate increases or reduced rate increases, particularly against the backdrop of the BOE's intervention when we did begin to see financial market turmoil. But again, central bankers are very clear, with the Fed specifically suggesting yesterday that the risk of curtailing fighting inflation or taming that action to do so too soon could be increasingly more risky than overshooting, potentially allowing, as I mentioned, inflation to become entrenched in the economy. So certainly a very difficult environment, financial market environment at this point, as we do expect central banks to overshoot their current targets. As you can see here, we do have the federal funds rate potentially rising up near 6%, with the curve remaining inverted well into 2023. But again, the pain to the economy, the pain to investors will be much greater longer term if central banks around the world, if the Federal Reserve does not reinstate price stability in the near term. And with that, I'd be happy to open it up to any questions, comments. General disagreements are always very welcome.
Okay, so thank you so much for those insights into what's happening in the U.S. economy. Certainly, you gave us a lot of information. We heard that the U.S. economy grew in the third quarter after contracting for 2 quarters, and that was really fed by growth in the net exports, although we saw that the domestic demand itself was pretty slow because the imports were declining. We also saw that the persistent high inflation is forcing faster spending than maybe wages are allowing, because wages are, lagging inflation, and so real wages are actually trending negative. And we also heard that we should expect more of this high inflation. So we're gonna have a question and answer segment right now for Dr. Paegza. And just a reminder to our audience on social media that if you have any questions, you can type it in the chat and we'll try to get them to Dr. Paegza while she's on. Do we have any questions at the moment? I do have one from myself. So I'm interested to hear how far the Fed could raise interest rates, and is there a potential for damaging the economic rebound from the pandemic based on these actions of the Fed?
That's a great question. And I do think, as I mentioned, that the Fed will raise rates beyond current expectations being priced into the market. But that being said, once we see the Fed funds rate rise to, let's call it about 6%, I do think that's a level elevated enough to result in the level of demand destruction that the Fed is looking for. Above and beyond that, however, if inflation does remain stubbornly elevated, it's likely a reflection of supply side pressures. Remember, we're not just experiencing demand side inflation as a result of trillions of fiscal stimulus and pent up demand, but we're also experiencing inflation because of supply side limitations, trade disruptions, international policy still leading to shutdowns, China's zero COVID policy, disruptions in the agriculture market and energy sector as a result of Russia's invasion of Ukraine. So at some point, with the Fed reaching an elevated level on Fed funds, there will be diminishing marginal returns in terms of each additional hike that the Fed takes, and then its impact on inflation. So at some point, I do think the Fed will realize they've raised rates high enough to control the demand side, and then it's a game of patience, waiting for international policies or international conflict to resolve in order to alleviate some of those supply side metrics. And I do think that the Fed is savvy enough to understand that differential, and they won't be willing to continue to raise rates above and beyond 6-7%. But that being said, if we do see those supply side limitations remain, it's likely that the Fed leaves us at this elevated level for some time, negating then the expectation of a near-term rate cut after reaching that terminal level.
Great, thank you so much. And you did touch a bit on the impact that it's going to have on a few of the sectors. We do have a question from Charmaine, who's on social media, and she asks, with the actions of the Fed over the last 6 months, does it make sense to target tech sector companies as those most likely to emerge from a recession? Those are most likely to emerge from a recession before other sectors.
Well, I think that was an investment strategy that was already being implemented prior to COVID, but certainly the aftermath of COVID and the current environment with the Fed tightening us potentially into recession is exacerbating that flow of capital into that sector. One other thing that I would add that's maybe fueling the demand for tech investments is a shift away from the traditional labor inputs into investment. As wages remain extremely elevated, even if we don't see further upward pressure from here, companies are increasingly investing in technology in order to replace workers or relying on technology to compensate for a lack of workers available in the marketplace. So from either direction, either one of those scenarios, I think that does provide additional support to say that the tech sector is one that is going to continue to be a positive recipient of capital flows as we struggle to get back to more normal growth territory.
All right, there you have it, Charmaine. We do have another question coming from Kamoy, who is interested in the crypto market. So Kamoy asks, should I be more focused on crypto with the volatility in the traditional asset classes such as equities, bonds, and currencies over the last 9 months?
Great. I'll take one more question. I think that when it comes to cryptocurrency, we do have to recognize what this reflects in the broader economy. And I would say that this generally reflects a hedge against fiat currency. And so by extension, then I would expect this to have a longer term return rate reflective of global activity. And with the global economy on the brink or near the brink of a slowdown, if not a technical recession, I would argue that there is mounting risks in the sector of alternative currencies at this point. Now, I'm certainly not a cryptocurrency expert, and I want to make sure that individual investors are taking into account their individual risk tolerances when we talk about adding that into a portfolio. But when we talk about the global economy potentially losing significant momentum from here, that is one sector that I would say poses additional risks to the investment portfolio.
Thank you so much. And we are mindful of the time. So I'm going to cut off the Q&A, the first Q&A session right now, and thank Dr. Paegzo for joining us. We've certainly been empowered with some great insights from your presentation and your responses to the questions posed by members of our audience. So thank you again so much.
Thank you. Thank you very much for having me.
Our second speaker today in this conversation of navigating the market conditions is Senator Dr. Andre Horton. Dr. Horton is no stranger to us. He's a Jamaican economist and politician. He is skilled in starter economic research, macroeconomics, international finance, and business and econometrics. Dr. Horton is a senior lecturer in economics at the University of the West Indies, and he's published several publications on interest rate volatility, monetary policy and stock prices, as well as social entrepreneurship. He holds a Doctor of Philosophy in Economics from the University of Essex and has been a member of the Jamaican Senate since 2019. Today, he will be providing us with a comprehensive overview of the market conditions impacting financial asset prices currently locally and that are expected to continue to do so over the next 12 months. Dr. Horton, welcome.
It's really good to be here. Thank you so much for inviting me to discuss with you the local economic conditions, micro and macro, so to speak. My presentation is going to be very short. I'm going to first look at the COVID-19 effects on different economic indicators. Then the big word inflation, that's been the main focus of many macroeconomic policies, both local and international. I take a look at that. Then I look at oil prices and the commodity markets. Then I look at the foreign exchange market because it's important for us to discuss that as well. Then I'll delve into what's been happening with our local stock exchange, the indices, see where they're going. Discuss gross domestic product and industry performance. Then we take a look at gross national income, gross national product, and overall productivity. Now, first of all, the COVID-19 pandemic was very pervasive, and it had a significantly negative effect on the macroeconomy of the world, as well as on Jamaica's macroeconomy. If you're looking at the diagrams on your screen, to the left, you're looking at labor productivity, which is output per person. And what we're basically looking at here is labor productivity before the global financial crisis of 2008, during the global financial crisis of 2008, after the global financial crisis of 2008, during the COVID-19 pandemic, and after the COVID-19 pandemic. So each of those blocks in the histogram represent a period of time before and after the two major crises that we have witnessed in our near lifetime. So the purple that we're looking at is the effect from the global financial crisis. Notice that it pushed labor productivity down by 1%. If you want to compare that with the COVID-19 crisis, that was more devastating. It pushed labor productivity down by over 5%. Albeit we saw some amount of recovery in productivity after the crisis in 2021 coming into 2022, productivity has been able to rebound. So Jamaica is gradually bouncing back and headed towards stabilizing our economic output and improving GDP. The GDP curves are very similar to our productivity measures. The only difference that's notable here is that after the global financial crisis, average GDP was positive while productivity was negative. But notice that the global financial crisis effect on GDP was about 2-3%, but the COVID-19 effect was about 10% on GDP. So that's what you're seeing on the right-hand side of the diagram on the board. And very similar to productivity, after 2020 and 2021 and so on, GDP has been recovering. Taking a look now at the second diagram, the other diagram, we're looking at employment on the left-hand side, similar metrics. We're looking at before crisis and after crisis, both crises, the global financial crisis as well as the COVID-19 pandemic. And notice that employment was negatively affected by the global financial crisis, but not as much as it was by the pandemic. Notice that employment declined by about 1% during the global financial crisis, and because of the pandemic, it fell by over 4.5%, which it has been recovering now after the crisis, and this is congruent with the GDP figures. We see that GDP is also increasing and employment is increasing, which is saying that more people are now going into the production process and adding towards our overall output. Inflation, the big elephant in the room, the big elephant in the country, the big elephant across the world. But what you want to notice is that because during the global financial crisis, Jamaica was a high interest rate regime. What do I mean by that? Interest of say 6%. So the effect of the crises, the global financial crisis of 2008, was larger on inflation than the COVID-19 pandemic, as illustrated by the yellow and red lines on those curves. So whilst the COVID-19 pandemic was very severe in affecting productivity, GDP growth, and also employment levels, it was not as significantly affecting the inflation rate as it was when we were a high inflation regime. Currently though, our inflation is gradually moving towards that high inflation regime that we had prior to 2010, when our inflation was upwards of 10%. Inflation for last year, year on year, was 9.3%, the most we've seen in over a decade. So let that sink in. And this inflation that we've seen between 2021 and 2022, year over year, was predominantly driven by, one, an increase in the price of food and non-alcoholic beverages by over 10.5%. Higher price for food, higher price for vegetables, higher price for plantains, cooking bananas, and these staples contributed to higher inflation across the country. Housing, water, gas, electricity, fuels, all were up by over 8.5%. Restaurants and accommodation were up by 19.4%, huge increase in the price of dining out, in the price of staying at a hotel. And key that we have to take note of is the 5.3% increase in the cost of education across the country. So we see where there was an increase in school fees, there was an increase in other school-related costs, for example, uniforms, for example, books. These contributed also to the inflation that we have been seeing on the macro scale across the country. Fundamentally, the Bank of Jamaica, and it's very similar to what we've heard from my colleague who was discussing the global economic issues, the Bank of Jamaica has been attacking the inflation through its monetary policy. They have set a target of 4 to 6%, but notice that the inflation rate is above 9%. And what we know is, based on the Taylor rule, is that for each percentage point that inflation is above target, then the central bank responds by increasing interest rates. So now you realize that us our inflation rate is about 3.5% above target, and the Bank of Jamaica has been gradually increasing our domestic interest rates to attack it from the demand side. Now, what do we mean by from the demand side? When the central bank increases interest rates, it makes the return that we're getting on these treasury bills more attractive. So instead of us going and purchasing a new Audi, or us going and taking out a loan to purchase a house, or us using our money on consumption items, then this money we are now incentivized to put into government instruments, or when the commercial banks, for example, VM, pass this interest rate through to their investment instruments, we are more encouraged to put our monies there. Now, what does this mean? The world is facing inflation from two sides. One, from the demand side, because of the stimulus packages that were handed out by large governments and the remittances that Jamaica got. And two, from the supply side, because of input costs, cost of commodities, wheat, oil, gas, etc., that goes into our production process, the cost of fertilizer. Now, the BOJ has found themselves in a particular policy stance, attacking it from the demand side, even though the origin of the policy is from the supply side. They're using a particular demand-driven approach. Now, we have to be careful, because what is happening here is that higher interest rates reduce the cost of borrowing. And if firms, for example, have additional investment that they need to participate in, they need to build out a plant and machinery, they need to expand facilities, they need to pay staff, whatever the reason that firms want additional capital to be invested in their businesses, then the BOJ has now made it more difficult for them to do so, especially when commercial entities pass through this increase in interest rates that we're identifying. And one good thing, though, about the increase in interest rates is that it is kind of preventing capital flight as well as investment flight from the country. So what do I mean? Because the Fed keeps increasing interest rate. Yesterday they increased it again to 3.75 to 4 percentage points. And basically what that will do is that will want us as domestic investors to take a look at those foreign instruments and say, okay, they're giving a higher interest rate. Let me change up my money in US and invest it abroad. But with the BOJ increasing their rate, then I might just be willing to let my funds stay here because I'm getting an interest rate of 5-6% that is a bit greater than that which we would fetch from the United States. So that's very important. Now, oil prices, and we have to zoom in on oil prices because in the 1970s, when we faced the oil price shock, 1973-74, oil price increased by 95% over those years, and it was devastating. It was one of the first time when Jamaica went to the IMF in a real serious way to get balance of payment support to purchase that needy input that we need to provide our businesses with energy in order for them to produce. Now, today, over the last 2 years, oil prices have more than doubled. They have increased by over 120%, right? It's going back down at this time, but if we were to check, for example, March 2020 to March 2022, then we would have seen a pervasive increase. And it's not just oil that has been increasing. You want to look at gold and other commodities have not been performing as much as investment instruments. If you're looking at 2020 and people are saying, oh, buy gold, buy silver, because these commodities are going to improve in value. Over the last year, we've seen the price of gold drop by 8.44%, and the price of silver has also fallen by 18.24%. So those hard ridgeline type of investment, commodities type of investments are now losing out in value, which presents to us the opportunity to provide investment instruments to substitute those hard lines. Aluminium, which is one of Jamaica's #1 exports, along with bauxite, the price of that has also declined by 16.4%, and it stands now at $225.51. If we want to look at inflation from the production side, the producer price index, mining and quarrying, the price of conducting those particular economic activities has increased year on year by 2.8%. Manufacturing prices have increased by 18.9%, call it 19%. Manufacturing, very difficult in Jamaica, affected by oil prices, affected by natural gas and those inputs. And the oil prices is really been affected because over the last year, there was a 43.8% increase in the cost of refined petroleum products. There was also a 14.4% increase in tobacco and food beverages, and a 12.2% increase in chemical products. So we're not looking at the CPI, that's looking at the consumer here. We're looking at the producers and the prices that they are facing across the country. Now, we realize that because the Bank of Jamaica has been increasing interest rates, there has been less pressure on the demand for the currency from the investment point of view. And what we've realized is that the Jamaican dollar, year on year, has been appreciating relative to our major benchmark currencies. To the US, we have appreciated by 0.55% or 55 basis points. With the Great Britain pound, you notice over the last couple of months or so, the pound has been losing value, and the Jamaican too has been appreciating on the pound. Year on year, we've appreciated by as much as 15%, and this is not a usual scenario. Jamaica, not necessarily a currency that advances against these major currencies. The Canadian, we've advanced on the Canadian by 7.6% year on year. So basically what we're seeing is that the monetary policy is being administered by the Bank of Jamaica, though it might be contractionary as it relates to gross domestic product, it has had advantages as it relates to exchange rate and as well as investment and capital migration. Now, in light of the exchange rate, we can look at imports and exports over the last month or so, or the last quarter. Imports and exports in the second quarter of the year, imports was about 708,000 US dollars, while exports was just 160,000 US dollars. If you're comparing both, then imports to the island is about 4.4% or 4.4 times, the exports from the island. And it has been so for some time. Jamaica, we're a heavily import-dependent small island developing state, and we have not yet found the matrix that is necessary for us to increase the value of our exports. And that is because value creation is not a focus of the national agenda of the country. Our national agenda looks at creating jobs. Our national agenda looks at providing resources, but it does not look at how we can use the resources that we have in order to create higher value added. So if you take our imports, we're importing Mercedes, we're importing computer, we're importing clothes. Most of what we're consuming, we import. And then we're looking to export some tomatoes, some onions, some scallion, mainly with a huge focus on agricultural crops, which has been falling given the level of inclement weather and so on. Our unemployment rate has been down 6.6%, the lowest we have seen in our lifetime. But consumer confidence up and business confidence are up. So there's a lot of potential that the economy can achieve. The stock exchange, between 2014 and 2018, the Jamaica Stock Exchange was on a huge upslope. I think 2015 we were considered the best stock market in the world. But notice during COVID-19, the stock exchange took a slight downturn, and this has continued into 2022. Year on year from 2021 and 2022, the JSE Select Index fell by 11%. The JSC Combined Index fell by 13.88%. The All Jamaican Composite Index fell by 10.7%, and the JSE Select Index fell by 10.31%. The index, though, that has been performing positively is the junior market, And what we saw last year is that the junior market increased by about 20.65%. So when we look at the main markets and we look at the junior markets, we're talking about distance to frontier, right? So if you're taking two oak trees, one is this tall and the other is about this tall, then the one with more room to grow has to be the smaller one, right? Because it has more, it's further away from its frontier. So this has contributed to the growth that we've seen or we've been experiencing in the junior stock market. GDP. Jamaica's economy grew by 4.8% in the second quarter of 2022, rebounding from the coronavirus. We're seeing gradual increases. Year on year, the IMF projected that we would grow by over 4%, but this has been significantly affected again by inflation, again by input prices, again by the producer price index that we saw that was negatively impacting manufacturing and output across the island. And the GDP growth has been driven predominantly by the increase in service provision. So service sector increased by 7.2%, but the goods producing sector fell by 2%. So we're talking about construction, we're talking about manufacturing. Mining and quarrying fell by 62%. Construction declined by 5.2%. However, almost all the other industries saw significant growth and return to their pre-pandemic levels. The manufacturing was up by about 33 billion year on year. Wholesale and retail up by about 74 billion. Mark Ho, the wholesale and retail industry is probably the largest industry in Jamaica based on what the data is showing. And the second largest industry is the producers of government services. So if you have an economy, for example, and the government provides the second largest amount to a particular GDP, the other industries, for example, financial intermediaries, these industries definitely need to step up. Year on year, the finance and insurance is up by 2.3 billion, which is a positive sign. And hotel and restaurants up by 45.6 billion year on year. However, they are 2 billion less than what it was pre-pandemic levels. So even though we're seeing increases in tourist arrivals, improvement in hotels' contribution, but when you compare what is happening now to 2019, it is about 2 billion less. It's about 2 billion less. This brings us to what's important. Gross national income in Jamaica has fallen from $5,300 per person in 2019 to $4,800 per person today. What does that mean? It means that Jamaica is classified as a developing country, and if we are supposed to move out of this bound of a developing country to become a developed country, then we need GNI, gross national income, of over $12,000. So the 5,300 that we were classified at in 2019, we needed this to improve in order for us to move closer to the 12,000 that will classify us as a developed country by 2030, Vision 2030 goals. But we are now regressing, so we are at 4,800. If we go back to $4,000, then we can kiss all this economic progression goodbye. Will be considered as a lesser developed country in a similar category to Haiti. You following? So it's an important thing because over the last 2 years, it moved from 5,300 to 4,800. If we continue on that same path, it will move from 4,800, assume it move by the same 500, to 4,300. It moves again, then we'll be going right back to lesser developed category. So we have to improve. And how do we improve? We improve by looking at our productivity, by looking at the types of goods and services that we place emphasis on our industrial policy. How do we use industrial policy now to feed into the financial sector? Because Jamaica has been growing from the financial side and the point of view over the last couple of years, over the last couple of decades. How do we now improve the value of these goods and services that we produce. So that's the questions that should be lingering on the minds of business practitioners. Are we in the right industry? Is this industry getting the right value added? Because value added is important if we are supposed to transition ourselves and to significantly move a nation of people up in the developmental ladder. I'll stop there, and then I'll open the floor to questions and so on when the time arises. Thank you so much.
Thank you. Thank you so much, Dr. Horton. You mentioned a lot of really thought-provoking things that are happening in our economy these days. You spoke about the pandemic having a detrimental impact on productivity and how inflation is soaring, similar to what Dr. Pikes told us is happening in the US economy. You spoke about the response of the central bank and that it has had certain benefits in terms of the foreign exchange market, for instance. You mentioned unemployment, you spoke about commodity prices and some opportunities that might present for investments outside of commodities. And then you spoke about the national agenda being focused on job creation and not necessarily value creation. And that's something that I'm going to want to come back to when we get to the Q&A section. And then you closed off with a discussion on the gross national income and the direction that we are going in terms of our classification as a developing nation. So with those remarks, we're going to take a little break right now, and then we'll come back and be joined by our Deputy CEO, Brian Fraser.
The Carolyn story begins in 2015 when I was exploring the opportunity to bring peer-to-peer lending to the Caribbean for the first time, initially investigating its possibilities for small businesses.
It was back in 2018 when Mark was actively looking for strategic partners to help accelerate the growth of the business.
Carolyn is a fintech company that has revolutionized borrowing and lending in the Caribbean, providing fully online services in a quick, affordable, and respectable manner.
It was back in 2018 when Mark was actively looking for strategic partners to help accelerate the growth of the business.
The Carolyn story begins in 2015 when I was exploring the opportunity to bring peer-to-peer lending to the Caribbean for the first time, initially investigating its possibilities for small businesses. We always had the intention of expanding the business around the Caribbean. After about a year of successful operations to prove that our business model was robust and efficient, we were then ready to take it to the next level.
It was back in 2018 when Mark was actively looking for strategic partners to help accelerate the growth of the business, both locally in Barbados and regionally. He visited Jamaica and made a presentation to us, and things happened from there.
We looked across the Caribbean for a partner that had similar aspirations and values to Carolyn and would be a good fit for us. We wanted someone who had a strong brand that consumers.
Our final speaker is our very own Deputy CEO for VMIL and VM Wealth Management, Brian Fraser. Brian joined the VM Group this September, and he's been working closely with our CEO, Res Burchinson, in providing oversight for our operations as well as all aspects of our fiduciary, financial, and operating performance. He has over 20 years experience in the financial services industry and has vast experience in trading, treasury, asset management, risk management, compliance, corporate governance, operations, and product development. If you have not already taken out your pens and papers, this is a good time to grab them, as Brian will be presenting strategies to optimize your investment portfolio during the current challenging market conditions locally and internationally. Brian, thank you so much for being here.
Okay, thank you, Nicole. Certainly a pleasure to be involved in my first in this series of Wealth Talks. I just want to say hi to all the viewers. And before I continue, I just want to acknowledge our two previous speakers, Dr. Payegs and Dr. Orton. Certainly delivered, very interesting and useful information. They have actually, covered some of the points that I had to cover in my presentation. I also want to acknowledge a few of my, a couple of my colleagues here as well. First of all, Mr. Conroy Rose, our CEO of VM Pension, and Mr. Michael Neater, who was introduced earlier, our CEO for VM Properties. In terms of all my other colleagues, Nicole, doing a good job in overseeing this event. And, for me, I just want to jump straight into my presentation. At this point, I don't have a lot of topics to cover. I will start by just, saying briefly who we are as VM Wealth Management. Just cover a few investment principles that have guided me over the years in terms of my journey in investment management. And also, we want to also just touch on some of the themes. As I said, I think the two previous speakers would have done that excellently already. And pretty much, I think I want to spend most of my time looking at investment outlook and investment strategy. So, who are we? VM Investment Limited is a subsidiary of the VM Group that is actually listed on the stock exchange. VMIL is an investment and financing company which is managed by a fully owned subsidiary, which is VM Wealth Management. VM Wealth Management has several business lines, including investment banking, popularly known as capital markets in Jamaica, where we provide equity and debt financing to mainly corporate customers. We have a treasury and trading business where we provide customers with the opportunity to gain exposure to both fixed income and equities, both on the local market as well as in the international market. And we also have an asset management business. And within our asset management business, we do manage portfolios on behalf of institutional investors as well as high net worth individuals. And within our asset management platform, we do cover all the major asset classes. We do cover both local and international fixed income. In our unit trust, we cover local and international equities, as well as alternative investment in the form of our real estate fund. So here at VM Wealth, we provide the solutions that will allow our customers to actually diversify their portfolio across all the asset classes. All right, having managed portfolios for over various economic cycles, largely pension funds, unit trusts, and mutual funds. If I may say, I would say what would have determined how successful one is in manage long-term portfolios is really just having sound investment principles and being guided by sound investment philosophy. There are 5 main investment principles that have guided me over the decades as to how I approach investment management. The first And the one that I think is the most important principle is just the concept of strategic asset allocation. This is basically the allocation of your portfolio across the major asset classes: fixed income, equity, alternative assets, etc. The next one is portfolio diversification. And portfolio diversification could be in many forms. It could be in asset classes, across industry, geographic region, currency. But why this is important is that it actually reduces the overall portfolio risk, therefore maximizing your risk-adjusted returns. The next principle is actually risk management. It is very important to set, investment limits based on your risk tolerance and ensure that your portfolio is managed according to those parameters. I've spoken to a number of portfolio managers, and as we reflect on the COVID pandemic, and especially in such a volatile period such as that, risk management is one of the most important things during those volatile conditions. And another concept that I would recommend and is that of being very disciplined and sticking to your investment philosophy. And finally, I would say you should always look to review and rebalance your portfolio based on the current market outlook. Portfolio optimization is definitely not a static process. It's very dynamic, and as such, you need to constantly review and rebalance your portfolio based on what is happening in the market. As I mentioned before, I just want to focus or zoom in on strategic allocation. That's the first principle that I've shared. This is one of my favorite slides. I stopped using it for a number of years, but just based on a debate, well, not a debate, interaction that I had on social media over the weekend, I decided that I would use this opportunity to just share this slide just to reinforce, as I'm talking to a lot of long-term investors in the form of institutional investors, is just the importance that strategic asset allocation play in the investment management process. And from the chart that you're looking at, you can see that the asset allocation is the most dominant factor that contribute or influence investment portfolio over the long term. We see security selection coming in far second at 5% compared to over 90% for asset allocation, and then behind that we have market timing. Why I spend time to go over that, especially during these type of market condition. I know, for example, my colleague Conroy, I know pension trustee tend to get jittery at this point when they are seeing negative returns in fixed income, negative returns in equity, and at this point you want to let them know that they need to stay the course, look at their long-term objective, and look at the asset allocation and ensure that they stick to it and be disciplined, especially during these market conditions. Then we want to move now to the main investment themes. They were adequately covered just now by the two speakers. We're talking about the elevated inflation, rising interest rates, as well as the looming recession. So I'm not going to go into that, but there's one slide as it relates to the recession that I want to, just spend some time on, and that is the one showing the relationship between asset classes and the various business cycles. As you can see, I believe we are in between the last two on the right-hand side between expansion and recessions. So we are seeing a mixed signal in terms of a number of the items on the left and a number of the items on the right. So we are seeing rising interest rate, yes. We're seeing elevated commodity prices, although not all, as Dr. Ahn pointed out. And we're seeing real estate market booming. We're seeing bond prices taking a beating. We're seeing stocks falling. So we know that we're somewhere, heading close to a recession. However, although we're very focused on what's happening in the next 12 months, I think we also need to, because we're taking a long-term view, we want to also focus not just on next year where we think there will be a recession, but we need to look at beyond and look at the asset classes that perform well in the recession, but also after the recovery, because you want to ensure that your portfolio is actually structured in order to take advantage of the recovery to come. So the next slide, yes, just jump quickly into our fixed income outlook. Not a lot to be said. I think it was said already. We expect in U.S. interest rates to remain elevated. Peaking now, I think that we had done this yesterday, and now we may peak above 5%. The range that we were looking at was more or less 4.5 to 5%, and we expect that in probably the end of the second quarter next year, and we expect those to remain elevated. And as the first speaker would have outlined, those are expected to remain elevated until probably the last quarter in 2023 or the first quarter in 2024. Locally, we actually expect interest rates to peak earlier, probably in Q1, between the 8 and the 7 and the 8% region. Why we believe this? Because we have to recall that our central bank actually started raising rates early, and that would have been one of the key factor that account for the appreciation that we saw in the currency year to date that Dr. Ahn covered. So what does this mean for our fixed income strategies going into the next 12 to 18 months? Well, definitely over the short to medium term, we would maintain our exposure to local variable rate bonds and local short duration bonds, so that we can continue to benefit from elevated short-term rates. And then, as both local and US interest rate peak, then we'll look to rebalance into longer tenured bonds, so that we can benefit from when interest rate start to reduce. As I mentioned before, based on how soon our central bank started raising rates, we would have seen an appreciation against most of the major currencies. However, if our central bank were to pause before the Fed, then we could see, not a high level of depreciation, but we could see some amount of depreciation going forward. And as such, just from a diversification perspective, we'll encourage investor to keep some exposure to hard currency bonds. During this period, as we head into a recession, we definitely want to focus on high credit quality instruments. As such, we prefer investment grade to high yield. And then, once we see signs of economic recovery, then we can then increase our exposure to EM and high yield, which that's the category that our local GOJ global bonds fit into. So the next slide that I will jump into, just a positive picture in terms of in a negative environment, the high yield market space. This chart shows that the year when the high yield asset class, the yields on those bonds peak, it is usually followed by a year when this asset class actually outperform the rest of the fixed income. So typically, we're in that cycle where bond yields are increasing. So what we're saying is that, okay, once those, if the peak is reached, say, early next year or mid next year, then we expect the 12-month thereafter to have significant return in high yield bonds, such as the GOJ global bonds. So this is something, the concept is actually true for all fixed income instruments. However, it is more pronounced for high yield bonds because they would have taken a lot of beating when interest rate is going up as they are doing now. Then we move on to, in terms of our equities outlook. Equities, US equities is expected, as our first speaker mentioned, we expect US equities to be bearish as the economy heads into a recession. We're not, and I didn't hear Dr. Arndt mention anything about any local recession. So for us, we're not expecting the recession in the US to be severe. We expect it to be short-lived, knowing that they have a presidential election in 2024. And because of this, we are not expecting at this time to have any significant impact on our local stock market. Actually, we believe that because our main market did not recover after COVID, and we actually believe that we could see some recovery late next year once inflation decelerates and supply chain issues stabilize. We, as Dr. Arndt mentioned, the pretty picture that we saw in the junior market, we are expecting that market to continue to outperform the main market, at least in the first half of the year. And that could change in the latter part of the year if we start seeing some recovery in the main market. This slide just captures what happened on the S&P over the last 3 recessions. And I guess the takeaway here is that, yes, we will see some dip in the equities market, but over the long term, and if you remain in the market will recover from the recession. And then the next slide is just reinforcing this. It shows what happened to the equities market the year before the recession. This is saying that typically the US equities market underperformed 1 year prior to recession, and then about 12 to 24 months after the recession, this market deliver return in excess of 45 to 80%. So again, for long-term investors, what we are saying is that you need to remain in the market so that you can participate in the recovery after the recession. Moving now to our equity investment strategies. On the local side is really a continuation of our main strategy for this year. Is really just to look to rotate into fundamentally good companies that are on the exchange that are currently undervalued. As we said, the market is yet to recover after COVID, so we see a lot of pockets of value there, that we just need to tap into. We want to focus on companies with good long-term fundamentals, good profitability, good management. What we have seen, especially even during the pandemic, is that companies with good management team and leadership, they manage well throughout even a crisis situation. And then we should definitely look for sectors we expect to outperform once the market recovers, probably in the latter part of next year. On the US side, With the possibility of a recession looming, we expect the market to continue to be volatile. Would have seen yesterday where persons were listening out for some some positive news from the Fed. However, we saw where all of that positivity was wiped away once the Fed released their announcement. So as we move into a recession, typically you'd rotate into defensive stocks that would typically outperform during a recession, and then rotate into cyclical and other growth-oriented stock after, in the latter part of the cycle, just before the market recovers. They say cash is king, but for me, do not stay on the sideline with your cash. As I mentioned before, you need to put that cash to work in the market so that you don't miss out on the recovery after the recession. Want to just quickly look at alternative investments. As I said, we have our CEO from VM Properties here, who probably could weigh in the Q&A section as it relates to the real estate market. For us, we are seeing the real estate space locally as being, we expect it to remain robust and competitive. There will be some pockets of that we have concerns about in terms of some significant price increases in local real estate. So we do have some concern based on the pace of increase, but we believe that that market still have some value. In terms of the U.S. housing market, we expect that market to cool just based on a number of factors: the high inflation, high prices, and with the recession expectation, we believe that will impact consumer and will impact the demand for houses in the U.S. So what is our strategies as it relates to alternative investment? For a long-term portfolio, especially if you're a pension fund, we definitely would recommend that you maintain exposure to alternative investment, just based on the diversification benefit that it brings to a long-term portfolio. As it relates to real estate, although we expect real estate to continue to benefit from elevated inflation over the short to medium term, as I said, we have some pockets of concern, and as such, our preference at this point, and not at this point, our preference for some time has been for commercial real estate over residential. As we would have seen in previous recession or previous downturn, that the commercial real estate usually perform better than residential whenever you have those softness in the market. As it relates to tourism sector, we believe that as it relates to real estate, that will still remain attractive given the recovery in international travel. And then generally, as it relates to private credit and private equity, we also believe that you should maintain some exposure to those segment of the alternative space, as they will provide your portfolio with that diversification as well as solid risk-adjusted return. What we'd recommend is that you seek a professional manager as you seek to gain exposure to those markets, both private equity and private capital, private equity and private credit. So I think we have covered the major asset classes, so I just want to summarize. Yes, we do expect the market conditions to remain volatile over the next 18 months, I would say, with the US recession looming over our heads. However, for long-term investors, this is not the time to be fearful and go into panic mode. On the contrary, you should be looking at this period as an opportunity to pick up high-quality assets at good entry levels, And as I mentioned before, you need to have a core investment strategy or a core investment principle and just be disciplined in your approach, especially when the markets are volatile. It's not the time for you to go, go wavering and, change strategy midstream because of just, slight changes in the market. You have to remain disciplined. And as I mentioned before, you have to use this time to review and rebalance your portfolio based on what the market outlook is. And finally, as I mentioned about 3 to 4 times, do not stand aside with your cash. You need to, if you do that, you will actually miss out on the recovery and you will end up wasting the recession. So that's it, and I'll open for question at this point.
All right, so thank you, Brian. I have a few quick takeaways. So you gave us your principles that you use to guide your investment approach: asset allocation, diversification, risk management, having a disciplined approach, and reviewing and rebalancing. And you mentioned that you recommend a long-term view, focusing strategically on the asset allocation. Sound advice you gave us, you urge us in this time as we approach a potential recession to look at high quality investments. So we do have a few questions from our audience on social media, but I want to kick it off using my moderator's privilege, because I did mention I had a question for Dr. Horton when you were speaking about what the national agenda looked like. And you mentioned that the preferred approach would be to look at the value creation as a part of the national agenda. So could you give us some color on what that would look like?
Yeah, when we talk about value creation versus job creation, we are basically discussing the difference between empowering the citizens with goods and services being produced that can fetch high value. What do I mean? Jamaica and Singapore both export a container of chips. The value of the chips exported by the Singaporeans is 6 million US, while the value of the chips exported by Jamaica is just 6 million Jamaican. Now what's the difference? Jamaica export banana chips, while Singapore export microchips. So coming out of the 1950s, when we left the Second World War, countries began to explore the industrial policies that would facilitate the infusion of technology and innovative driven products into their production processes. Here, Japan had a big recycling project. Singapore and these countries embarked on these types of goods because of the value that they can bring to them. Our main focus here in Jamaica recently, we have one tourism. We haven't been able to retain much of the dollar here, especially as it relates to the employees. Many of them are minimum wage earners. And we put a lot of emphasis also on a new BPO, which has been good because it is a significant creator of jobs. But in terms of generating those value-added products that can fetch us upwards into the billions of US dollars, remember that as a small island developing state, majority of what we consume are imported. If we were to look around the room and we look at the garments that we wear, we look at the gadgets that we have, we look at even the cameras and the TV, as well as my computers, as well as even probably these flowers that are here are imported. So we have to now begin to look at what of value do we export? We export bauxite, we export tourism, but is this significantly enough? And the answer, I'll put it to you, is no. So we definitely have to now start to think about how do we create a technology-driven program? How do we innovate? How do we start now to look at the future to see where the world is headed and to meet them halfway? And the financial industry can definitely play a role. You look at the Cayman Islands. You look at the Bermudas, you look at Panama, as it relates to the Panama Papers as an example. Jamaica have the ability to really participate in global financial trade and creating a financial hub similar to those countries. And from a goods point of view, we also have the potential, but we just have not been fully exploring the solar prospects, the water prospects, and also the air-driven and wind-driven energy type of prospects.
Definitely, certainly a lot of things that we could explore to drive that value added. We have a question from Rob for Brian. Rob asks, as someone who has been working for less than 5 years, but who has only about 20,000 to invest per month, where would I be best served investing for the next 5 years?
Okay, Rob, you have started working recently, so I'm assuming that you have a lot of time on your hands. So if I were to guess, once you have gone through your meeting with your advisor, you will see where you will have an allocation that is more focused on growth in terms of equities. So I believe that as a young person with time to recover, then a larger percentage of your investment would go to growth securities at this time.
Great, thank you, Brian. Beverly on Facebook is asking the $1 million question of Dr. Horton. She wants you to give us some insight as to whether the Jamaican economy is heading into a recession and what is happening, just like what is happening worldwide.
When you look at the domestic economy, you see a lot of potential. You see where we now are concentrating on exfoliating the primitive economy that have established over the last 70 or so years. If you look at the infrastructure across the island, you'll realize that it is only just now that it has been gradually being replenished. So the idea is that Jamaica and other small island developing states, as well as emerging economies, are very far from their distance to frontier, which means that a lot of the infrastructural build-out that we need to improve our doing business, improve our standard of living, a lot of this has not yet been done. So these will contribute towards keeping the economy a buffer above where we would generally see the recession indicators coming into play. And it's a general idea that if we continue to build out these things, then we should be able to really hover above that particular recession threshold. But it is possible because we're an import-dependent nation. And if we are relying on tourism from abroad, relying on demand from abroad, relying on income from abroad, relying on remittances from abroad, then that's a heavy, heavy part of our basket being subcontracted to abroad. So if they are affected, yes, we're affected, but given how far we are from our distance to frontier, the build-out should be able to keep us afloat.
Another question for you, Dr. Horton, from Neil on Facebook. Neil asks, what is the impact of the rising inflation rate on the food basket going into Christmas? Is there any relief coming next year in 2023? And what measures can we look for from the government and other agencies to support the people?
Yeah, if we were paying attention, then we realize that much of the inflation that we're seeing now is really driven by food prices as well as non-alcoholic beverages and so on. Fundamentally, if we do not stabilize output, then we cannot stabilize prices. And Jamaica's output, especially agricultural output, if we're talking about food prices, if we put imports to the side for a minute, because of heavy rainfall and heavy hurricane-related activity, storm-related activity, then our agricultural output has been affected, right? As well as when there's no hurricane or there's no flood, we are affected by drought. Going into the Christmas season, you will realize that some products, because we're in the rainy season from September going down, it's sort of the rainy season that's going to impact our domestic agricultural output. So we don't expect prices to come down anytime soon. However, if it is the case that we are looking at overall consumption, because of global commodity price increases as well that goes into the productive processes, then we are not expecting prices to be lower headed into Christmas.
Okay, we're trying to get as many questions in as we can. We have a question for Michael Neto, our CEO for VM Property Services, from Judith. Judith asks, over the past several years, I've invested heavily in real estate. Would it be advisable going into 2023, looking at the state of the economy and inflation?
Why not?
Thank you, Judith, for the question. Real estate is a long-term asset. If we look at the trajectory of real estate, over the last 30 years, I don't think we have seen a dip in values. It has steadily increased. It has increased. It increases in lumps, but it has always increased. And given the stock of real estate that we have, primarily on the residential side, there's always demand in the lower to middle sector. There's limited supply. That supply comes, but it comes much lower than the demand. So it is always a good investment. And it's a long-term store of value. So certainly.
Thanks so much, Michael. And we have one for Conroy Rose, our CEO of VM Pensions Management. Conroy, how has the current economic conditions impacted the performance of pension plans, and how have you responded?
Very good question. Under the current economic market, we have seen where several asset classes are pretty much down. All the speakers before made mention about them. But most importantly, what Brian made mention is that for pension fund management, it is critical for us not to panic, because the strategy is really for long term. So the key is to constantly monitor the investment, review your investment, and then rebalance. So this is a strategy that most of us use as fund managers. And I will say the same for individuals, persons who are invested in a approved retirement scheme. I would say to you that you would take the same approach. Do not panic. Look at those markets that are performing well, and you can increase your investment in those areas. And the markets that are underperforming, you can minimize. So it's important as an investor in the ARS, which is self-directed, for you to sit with your advisors, your fund manager, because, for example, us at VM Pensions, we allow you to rebalance your investment on an annual basis. As a matter of fact, free of no cost. And in situations like these, you are given the opportunity to really redirect your contributions into those areas that are doing well and those areas that are not doing well, so that you're preparing yourself for the resurgence of the market. And most importantly, Dr. Hartney made mention about certain industry, value-added industry. We need to look at investing in like the value-added industry, for example, private equities in the growth areas. And we at VM Pensions, we have recently created a private equity portfolio that we believe that is something that most investors should look at, because we as investment managers, we look at companies that are good companies, good fundamentals, good management structure. And when you look at scalability, the scalability are great. So I would encourage persons to look at private equities as an area for possible growth.
So unfortunately, we have to cut it here. We wish we could stay longer and take some more questions, but it's just left for me to thank you all so much, those of you who have joined us, who have stayed engaged. I know you're walking away from this more prepared to optimize your portfolio and leverage the current market conditions to your benefit. To our speakers today, Dr. Paegza, Dr. Horton, Brian, we appreciate your input, your perspectives, and your company this evening. Thank you all so much for being here with us. Ladies and gentlemen, this has been another in our Wealth Talk series. We would love to continue hearing from you about what was discussed here today, about any of our products and services, or to speak to a wealth advisor. You can reach us at 876-960-5000 or by email at vmwmclientservices@myvmgroup.com. Thank you again and have a great evening.